Welcome to This Explainer. Today, we're going to unpack the exact step-by-step path to take you from being a super diligent saver to a confident investor. And we're going to do it without you feeling overwhelmed or risking your financial security. If you've got some cash sitting on the sidelines and you've been wondering how to actually start building real wealth, you are in the exact right place. Picture this scenario, because it happens all the time. You finally do the responsible thing. You start saving money every single month. You move a little bit into your savings account, maybe $100 here, $200 there. You're feeling incredibly good about it, right? You feel responsible, disciplined, and financially mature. But then one day you open your banking app and boom, you're staring at a solid $10,000 just sitting there in your savings account.
And then you look a little closer at the interest rate. You realize your account is earning a paltry 0.5% interest. What does that actually mean in reality? Well, it means that your 10 grand after sitting there patiently for an entire year made you a grand total of just $50. Yeah, $50. Meanwhile, you keep hearing everyone talk about investing, stocks, index funds, and compound growth. And suddenly you start wondering, wait, am I doing this wrong?
And that brilliantly illustrates the core concept we need to tackle today. Here is the slightly controversial truth. Saving money alone will almost never make you wealthy. Now, don't get me wrong, saving is incredibly important, but it's not the final goal. It's just the first stage. See, savings and investments have two completely different jobs. Savings exist to protect your money, while investments exist to grow your money.
To put that into perspective, let's look at the staggering math behind those two different jobs over a 20-year period. Let's imagine you save that $10,000 in a typical savings account earning 1% interest. After 20 years, you've got about $12,200. Not terrible. But let's compare that with investing. Historically, the stock market averages about a 10% return per year over long periods. If that same 10 grand earned 10% annually after 20 years, you're looking at roughly $67,000. That's the exact same starting money, but a completely different outcome thanks to the magic of compounding. The biggest wealth gap in the world isn't usually between people who save and people who spend. It's between people who save and people who invest.
So the crucial point is understanding why most people never make that transition. The reason isn't the math. The math is obvious. The reason is entirely psychological. Saving just inherently feels safe. When your money sits in a savings account, you can see it, it doesn't fluctuate, and it certainly doesn't drop 5% on a random Tuesday afternoon. But investments, they move. Sometimes they go up, sometimes they go down. And that emotional volatility scares people away. It just feels risky.
Let's look at the blueprint for a staged transition.
It is completely fair to not want to lose your hard-earned savings. That's exactly why the transition from saving to investing should never happen all at once. So we're going to break down a clear 5-step blueprint. This is the exact roadmap to get you off the sidelines and into the wealth-building game safely and confidently. Let's take these one by one. Step 1 is foundational. Before you invest a single dollar, you absolutely need to build a real cash emergency fund with 3 to 6 months of living expenses. This money stays in savings. It's not for investing, it's not for seizing sudden opportunities. It is strictly for unexpected problems, like a job loss, sudden medical emergencies, or a surprise car repair. Why is this step 1? Because the biggest reason people panic sell their investments is that they suddenly need the cash. A proper emergency fund crucially protects your investments from your own life emergencies. Step 2 is where we tackle the psychology. You have to mentally separate your money into two completely different buckets. Bucket 1 is your safety money. This is your emergency fund. It does not move. It takes zero risks. It just sits steadily waiting for an emergency. Bucket 2 is your growth money. This is the money you're investing, and crucially, you have to give it permission to fluctuate. Its entire job is to grow over a long timeline, so daily ups and downs simply don't matter. This mental separation is a massive psychological shift that will drastically reduce your anxiety. Step 3, start small. A lot of beginners mistakenly believe that investing requires thousands of dollars just to get through the door. It absolutely doesn't. Many brokerage platforms today allow you to begin with just $50 or $100. When you're just starting out, your goal isn't to make massive profits on day one. Your goal is simply building the habit. Establishing the habit of investing consistently matters way more than trying to perfectly time the market.
Okay, moving to step 4, focusing on simple investments. This is where beginners constantly trip up. They jump straight into incredibly complicated strategies like day trading, options trading, or wild crypto speculation. But the secret of the wealthy is that the simplest investments often outperform the complicated ones. Instead of trying to pick individual winning companies, you can just use broad index funds. These funds track the overall stock market, meaning you're instantly investing in hundreds of companies all at once. You get built-in diversification, lower risk, and steady long-term growth. It's wonderfully simple, and it absolutely works.
In fact, this quote-unquote boring strategy is so profoundly effective that legendary investor Warren Buffett has repeatedly recommended low-cost index funds as the absolute best path for everyday investors. When one of the most successful investors in human history tells you to keep it simple, it really pays to listen.
Step 5 is all about staying disciplined and letting the math work for you. Let's see compounding in action. Imagine you invest just $300 a month. If the market averages an 8% return per year, after 25 years, your total account value hits roughly $285,000. But look at how this breaks down. You only actually contributed $90,000 out of your own pocket. The massive remaining chunk, almost $195,000, is pure investment growth. That is compounding working in your favor, doing the heavy lifting for you.
But to get that massive growth, you've got to maintain your discipline when things feel uncomfortable. Markets will go down, news headlines will get incredibly dramatic, and people will panic. To stay the course, I want you to remember this simple analogy. Saving money is like storing seeds safely in a glass jar. You're protecting them perfectly, but absolutely nothing is going to grow. Investing is taking those seeds and planting them in the dirt. At first, it just looks messy and volatile. You don't see results immediately. But over time, with patience, those seeds grow into something much, much bigger than what you started with.
Now let's talk about surviving market crashes. Because I know you might be wondering what happens when the market crashes. Well, long-term investors actively benefit from them. Think about it. Seasoned investors know these downturns are completely normal historical occurrences, and they think in decades, not in days. When the markets drop, the prices of your index funds drop too. That means your consistent monthly investment is suddenly buying way more shares at a major discount. You're essentially accumulating assets on sale, which sets you up for significantly stronger returns the moment the market inevitably recovers. Ultimately, the core takeaway from this explainer is that you need both of these tools working together to build true wealth. Saving money gives you a foundation. It provides you with essential stability and peace of mind. But investing your money, that is what ultimately unlocks your absolute freedom. The earlier you combine both stages, protecting with savings and growing with investments, the more powerful your financial future becomes.
So, as we wrap up this blueprint, I want to leave you with a question to reflect on your own financial habits right now. Take a hard look at your accounts. Are you still entirely sitting in the saving stage, just protecting your seeds in that glass jar? Or have you already taken the leap, planted those seeds, and moved into the investing stage?